This is a whole new world we're in. Things have really changed in a massive way over the past couple of years. That's accelerated over the past year, past couple of months, really. And what we're witnessing right now has the potential to change the whole global configuration. Alliances that we've seen for our entire lives, we all grew up with the NATO alliance. That's in some significant doubt as to whether it's going to continue. And, we're going to talk about what the world looks like under the new configuration that seems to be developing. But all this stuff has massive implications for us as investors. So diving in, this is kind of what the situation is right now. As we look to, you've got China. We've got a return of essentially what in the older days would have been called mercantilism, where trade blocs are pursuing their own individual interests as opposed to a more globalist ideology that was going on. These trade blocs that are developing, you see Europe is turning into its own. It is moving away from our sphere of influence and forming its own, despite the fact that there are trade deals being touted and they're saying, hey, this brouhaha over Greenland has been smoothed over and we're going to fix things. Europe has lost trust in the United States to a large degree, and they're wanting to go it alone. So much so that they're making plans for their own military presence without us involved and so forth. There are quite a few things of this nature that are happening. So what does that mean for us as investors when you've got Europe acting as its own, you've got the United States, and we're not exactly on friendly terms, so to speak, with Canada at the moment, where that's a little bit in doubt. And so this map has shown a United States sphere of influence, and the light blue represents parts of the world that are likely to go our way. The light, the green over there is Europe, the orange is Russia, and then you've got China. Gray is kind of up for grabs at this point, but we are seeing competing spheres of influence at this point. So industry is going to change. Globalism was a different animal. What are the risks? And the risks are increasing. Well, we've got war potentially, and conflict is more likely because we've got nations, great powers that are in direct competition with one another now, whereas it used to be much more overt. And it used to be much more through economics. So the potential for armed conflict is larger. There will be probably proliferation of nuclear weapons to states that did not have them or maintain arsenals because they don't feel that they can rely on NATO's old nuclear umbrella. So that will be a development. And then arguably the odds that those will ever be used, even in a state where, a state of the world where most people have them or most nations have them, that's still extremely low, but it is higher than what it was a few months ago. There will be global increased military spending, which is not necessarily a terrible thing. As it turns out, military spending does drive economic growth. So we'll be watching for that. There are frictions to international trade, which we are worried about. These tariffs and the escalating rounds of tariffs that are coming from us, and then we get in retaliation from Europe, let's say, or from China, or even from Canada, which they're talking pretty loudly about right now, instituting against us. These things are potentially damaging economically. So as investors, we're a little bit more worried about that. But there's opportunity. And by the way, these are the only verbal slides I'm going to bore you with. The rest are all pictures. But these separate trade blocs do create more opportunities globally. And when I say that, there's a distinct infrastructure for each industry within each of the trade blocs. So you're going to have more potential winners and more potential losers, which means more opportunities as investors. You just have to be better at it and doing the research, finding out what drives a company to succeed versus fail, than you did for the past 40 or so years when we had a different kind of market where the averages were going up pretty steadily and you didn't have a lot of dispersion around them. And that's a theme that I intend to come back to here in a few minutes. Currencies. This has been in the news a lot. So especially over the past couple of days, they've been talking about the dollar not doing well. And they're looking at a thing called the DXY, which is the dollar index, or they're looking at the Bloomberg US dollar index. And as such, that's weighted by global trade. So when you look at DXY or you look at Bloomberg's dollar index, what you're really looking at is the euro to dollar cross. You're not looking at anything else. That's 38% of those indices. So if you want a better picture of what's happening with the dollar, you do what I've done here, and that is you decompose it and say, what has the US dollar done against all 7 of the other, major currencies? And you do that for each currency. So this chart depicts the actual strength of each currency on an absolute basis as opposed to relative to 1 or 2 currencies. It's interesting to point out, and it's going to be tough to see. I'm going to throw a dot up here. This is the United States. This is the US dollar. This is January 20th, the date that we announced that we want Greenland. So there has been, in fact, according to the news media, an exodus out of the US dollar assets. And in fact, you can say there has been a big drop in the dollar's value over that time period. However, it's still one of the top performing currencies. And what we also see from this chart is, decomposed-wise, the Swiss franc is the best performing currency, followed by the euro, and then the US dollar. So with that, what does it tell us? We're not in the same world we used to be in. It used to be that the Swiss franc was where everyone went when they needed safety, along with the US dollar and the Japanese yen. Here's the Japanese yen right now. That's the worst of the pack. So, what are we to make of it? And there is something to be said for the fact that in our business, in the business of investment management, very few people, if any, in my business have worked through a cycle where the world was configured the way it's becoming configured. We all had globalism that we grew up with. And so having to look back into history and having to figure out how things work again creates a massive amount of opportunities in the marketplace that we are positioned well for. But, overall, the market averages are not necessarily well positioned for. There's the economy. And this graphic kind of depicts the rest of the world losing faith in the independence of the Federal Reserve. And that is a big problem because the independence of the central bank is kind of pivotal to why investors want to come here. They want monetary policy to function correctly. They want to know that it's not politicized. And under the current situation, it doesn't look independent anymore. And whether that remains to be seen or not, is still up for grabs, although we have some pretty strong opinions here in our team that the Federal Reserve has mismanaged the monetary policy over the past year and a half, 2 years, and we'll get into that now. What should it look like? Textbook. I come from an economics background, so textbook monetary policy is supposed to put the brakes on a roaring economy, and it's supposed to accelerate a slowing one. And the rate cutting cycle that we've been on may or may not be justified too well, based on information I'm about to show you. Here's what GDP growth, the gross domestic product, in other words, all of the economic activity in the United States. And I've overlaid periods of recession in red. Those columns in red are periods where we were in a recession over the past, I'd say, 40-ish years. And we are growing at the top end of that entire period, barring the big outlier of the rebound after 2020 when the economy reopened after COVID. 4.4% is more than double what economists consider to be the sustainable growth rate for a developed world nation. So are we dealing with a weak economy that justifies us being in a rate cutting cycle from this basis? Absolutely not. In fact, you could argue that the economy is uncharacteristically strong right now. Unemployment is only 4.33%. And when I went to economics class, we were always told 5% unemployment is the full employment rate of the economy. Anything lower than that means the economy is running quote unquote hot. So again, does the labor market seem to justify rate cuts right now? No. but we're cutting, which is inflationary. That leads to ultimately potentially a vicious cycle. And I want to backtrack for just a second because I didn't mention it up front, but I do these not so much to come up here and lecture, so if there are questions, please stop me in the middle. This is more of a conversation. But so far we've seen two pieces of evidence that the Fed uses to justify what they do, and these are in fact the dual mandate. The Fed is there to manage inflation, manage price stability, and manage the labor market. So the labor market looks fine. The economy looks like it's running a little bit hotter than it should be. Non-farm payrolls was only 50,000 on the last reading, which doesn't sound like a lot, and it isn't a lot, but it's not shrinking. So we're a bit worried about this rate cutting cycle, particularly if they cut rates again. We're worried that inflation is going to pick up. And speak of the devil, there's the consumer price index, which came in at 2.7 on the last reading. That's much higher than the 2% that they target officially at the Federal Reserve. So you would think that instead of cutting rates, maybe they'd be thinking about hiking them. But, I'm not working there. Not yet. I like that, whoever said that. So here's the measure that the Fed uses, which is even worse. So the Fed uses what's called the Core Personal Consumption and Expenditure Index. And this is saying 2.8 is our inflation number. So that's even higher. Arguably, there has been some pushback. Finally, a couple weeks ago, Chairman Powell came out and made a statement and said, look, we really can't have our independence threatened, and we need to maintain that. And we really were pretty happy to see that. It sent a good message to global investors. It sent a good message to market participants. And now you're hearing a lot more dissent on the Federal Reserve Board of Governors. So perhaps they will avoid some of these policy errors that they've been making over the past 2 years going forward. I hope so. But, time will tell. The Fed funds rate, this is charted all the way back to 1954 or so. And as you can see, for the lion's share of that time frame, and I know that this dot probably isn't going to be visible on video, but the lion's share, the rate was much higher than this. Conditions very similar to what we have now. Periods politically that were similar to what we have now include right around here, right around here. All of this was a result of globalism because cooperation is disinflationary. So when now everybody's at each other's throats, that is somewhat inflationary, we're in a much more analogous environment to this period. The rate cut probabilities have gone down. This chart's fancy, and I don't want to spend too much time on it, but it does illustrate something important. Market participants who are forecasting and saying, hey, what do we think the Fed is going to do? What's the Fed funds rate going to be? They're hedging in the interest rate futures market. And positioning suggests that there is a 44% chance of a rate cut by June. One rate cut, so another 25 basis points. That's how people are positioned. And don't need to get into the arcane math behind it. If you want to ask me about it afterwards, I'd be delighted to talk about it, but probably that will bore everyone else in the room to tears, so we won't do that. But this was over 100% a couple of weeks ago. So it does appear that market participants are taking the messaging from the Fed seriously and saying, hey, we're going to probably moderate our policy. So coming back to the idea that cooperation is disinflationary, is this slide. A rising tide lifts all ships is an old adage. And when everybody's in it together, there are cost efficiencies. You can use the Adam Smith division of labor, which says, hey, if you're best in this nation at producing this type of widget, and you're not as good as that one, but the other nation is, you specialize, you produce your widgets, and everybody gets a better product at a lower price. That was the world we inhabited for about 40 years prior to now. The world we're in now is every man for himself or every woman for herself. And it's not a terrible thing. I mean, this looks scary, but you have some doing really well, others not so well. And that increases what we call the dispersion of results. So, market averages are the net result of all of the average result of all of the participants. And when we talk about the results of any individual one, I'm going to backtrack a slide. In this environment where everyone was cooperating, everything was kind of clustered. Everyone was going up nice and gently together and growing their economies, and things were pretty good for the most part. Now it's going to be much different, between the different market participants and the different nations' economies. So is that necessarily bad for us as investors? No, that's good, so long as you know how to identify what's happening. It's not good if you're Vanguard and you want to invest in the index. You need what's called active management. And not coincidentally, if I go back a few slides to that peak where interest rates were much higher and inflationary pressures were there, the active money managers did much better than the indexers during those periods. Not because they could pick every winner. No one can do that. But because they could figure out how to avoid the big losers. And therefore they get a higher return than the overall index. So we expect active management to do a little better going forward. And this is what's happening with the averages. And this will be hard to see. Anybody that wants a copy of this, I'm sure we can distribute a copy of this slide deck out to you. We've got your contact information. But all across the investment analyst communities, there are what we call capital market expectations that are put out. And the average of all of those says that, hey, short-term treasuries are expected to do somewhere under 5%, something like 4% in returns with a very low. In blue are returns expected, in red are expected volatilities. So you have treasuries, short-term treasuries in cash, you have inflation-protected bonds, you have government agencies, and then municipals, and then you have corporate bonds. U.S. domestic large-cap equities are only expected to return about 6% annualized over the next 10 years or so. And that's across Wall Street, that's across the City of London, financial analyst community over there in England, and so forth. So that's much lower than the 20 and 30% that we've been used to here. And it's across the board that everyone's calling for these lower results. However, when you look at the expected volatility, that's much, much higher. That's closer to 15%. And what that's telling us is there are going to be a lot more winners clearly defined and losers clearly defined. So the name of the game will be avoid the losers. You can't play the pick the winners game. No one knows. But this also upends decades of investment performance where United States large cap equities has outperformed most of the other asset classes. That's no longer going to be the case. And so in our team, when we go and do our rebalance, which is happening in the next couple of weeks, we're adding to smaller capitalization companies and we're adding to foreign companies as well. Because as you look, small cap is a higher return, emerging markets even higher, international, and then developed world, small cap. So we want to have more of a traditional mix. And people think, oh, it's going to go back to quote unquote normal. No, what I'm showing you here is normal. We had a 40-year-old anomalous period where it was not normal. Now we're returning kind of to normal. And it's marked by that lack of cooperation that had been present during the period. But for those that position themselves well and know the timeless principles, this is going to be all right. It might be scary to see these institutions that we've all grown up with change so radically, but it really does represent opportunity. The S&P 500 thinks so. That's basically closing out the year right at all-time highs. And they say, and I quote, "The market climbs a wall of worry, and it falls down the slope of hope." So all of this, news that's out there that's frightening. Oh, the alliances are changing. We're having tariffs, this or that. That's actually fuel for a rising market. And you can't find a bull market in all of history that did not have a reason to be very afraid. We look at equal weight, that's gone up by a little bit less. So this is the past year. And the S&P equal weight was only up 9.5%. I'm going to backtrack a slide again. This is the S&P as it's on its own. That was up 16.5-ish. Why? Well, information technology stocks have grown to an enormous proportion of that index. We're at the point in our investment team where we're having debates, is the S&P 500 even an appropriate index to be benchmarking against for, market exposure for a sane client? Because what it's turned into is mainly a tech index. So, in 2015, 20% of the S&P was technology. At the end of 2025, it was 33%. And that's actually come down slightly because technology took a big hit toward the end of the year. I don't know if you recall, there was a big slide at the end of the year in tech companies. It was closer to 35 or so, 36. That is a 54% increase in representation in the index over the 10-year period. So we're having discussions, serious discussions, about what do we benchmark against. And we have to use the S&P because that's what everybody knows. But the reality is that's become much more technology focused. And then at the same time, financials came down over the same period by 26% in representation. Consumer discretionary lost about 20% of its exposure in the index. So we're watching a restructuring of our economy, which will probably restructure the other way now that we're moving into a new environment. And this all represents opportunity for us. Treasury bonds. This is the yield curve. And we've got 2 points plotted here, 2 curves. The bright green one is as of a couple of days ago when, this was created. And the other one was from 9/17 of 2024, which was the very beginning of our rate cutting cycle at the Federal Reserve, when they said that the economy was in dire trouble and, we need to lower interest rates. And if you look, it does work at the short end of the curve. So this is out 3 years. So below 3 years and in, the curve shifted down by almost a full percent. However, out past 3 years, it's rising interest rates. And that's counterintuitive. People don't understand that, when you lower the short-term rate, it's an inflationary pressure. But at the long end of the curve, at 10 years and out, the main input to the pricing of yield is, what are the inflation expectations? Do we expect prices to go up? And if so, we don't want to lend money to the government at some percentage now and lose our purchasing power because of inflation. So we have to price for that in the bond yield. So 10-year investors went up by about 0.5%, almost 0.5%, 40 basis points. And that's since they cut rates. What is it now? Travis, friend, do you have an idea? How many? What do we have, like 8 cuts or something like that? 7. 7 by quarter points, yeah. So we've cut by 175 basis points. And yet 10-year rates are up by almost 0.5%. That's Treasury bonds. There's another bond rate, which is in corporate bonds. And it looks like I was showing you corporate bonds. So I'm sorry, 60 basis points on Treasuries and 40 on corporates. But corporate bonds are also priced on a potential for a company to default on their payment obligations. The government is presumed to never, be in a position to default. Although we did get our rating cut by S&P a few years ago. No longer AAA, we're AA plus or something like that. With that said, this tells us something else. This tells us that, stress on companies is not so much of an issue as inflation. If the Treasury is up 60 basis points in yield at the same period and the corporate's only up 40, that means that the default risk premium is actually declining. They're expecting companies to do better under these circumstances. You know, when I say they, large bond investors are expecting companies to do better in these circumstances. So it remains to be seen. But if you're a fixed income investor, or if you're a balanced account investor like many of our clients are, where you have some of the account in bonds to get income, some of the account is in stocks to get growth, these rates are great. If we can get you 5% or 4%, you guys remember a few years ago when we were getting like, what was it? 1 was great. If you could get 1, Laura, what was it? What was money market? I mean, do you remember? Like, it was like a basis point or something like that, like 0.001% or something. So these rates are profoundly good, and they allow us to position portfolios the right way. You want to have bonds and stocks in there to some proportion to balance risks, you know. And the way that I say it on tables, a lot of you in this room, I've sat on a table with you and I've used this. You know, you want assets that are zigging when the other ones are zagging. And that's how stocks and bonds tend to work in healthy market conditions. Over the long term, does any of this scary stuff really matter? I mean, I heard a laugh out there, like maybe, but you're right. It maybe does, but if it doesn't, we stick to a long-term plan. That's the way to play this. We get together, we sit down, we discover what your financial goals are. Your goal isn't to get the index exposure. Your goal is to achieve your financial goals. 2 different things. You can get the index exposure and have the risk commensurate with that, or you can have the minimum amount of risk you need to take to get your goals achieved, and that's kind of what we do. And that's basically where I'm going to end things from my prepared remarks and open it up to questions. The question is, what are the overall effects of us losing dominance in the currency markets? In other words, the dollar losing its status as reserve currency. And that's a really good question. And we're already seeing some of the ramifications of that. You saw that slide where I decomposed currencies according to equal weighted returns as opposed to what they quote on Bloomberg and CNBC. There was a massive outflow from dollar-denominated assets in the intervening period since this Greenland thing. And that's a big deal. I want to say it dropped by somewhere around 4% at that level. And that's not the metric that you'll hear on the news because they're measuring the other index. So their measure is actually going to be worse than mine. But the impact is going to be a fracturing of our influence. We're going to lose the ability to sell bonds at yields that we're selling them now, being the biggest one. So despite the fact that they're talking about we're going to lower rates, our interest rates are going to go up as a result of that. And it's because we can't sell as many bonds to foreign investors. The Danes, I believe, came out with their pension fund and announced immediately that they're selling their entire holdings of U.S. Treasuries. If that trend continues, we could see sharply higher interest rates if that continues, but we don't know it will. And if it does, everything gets equilibrated. But let's say interest rates go up by 5%. Interest rates are in the denominator of stock model valuations. So if we're valuing stocks and we have a denominator of value that's going up, that means that stock prices are coming down. So we would expect a market fallout from that. I think that the 10-year is going higher. However, all isn't lost. They're not underwriting, as you know, they're not underwriting adjustable rate loans to the same way they were in the aughts, where we got the great financial crisis. So there will probably be a movement in toward loan products that are structured as variable, shorter term, tied to the 5-year or the 3-year, as opposed to, the 10-year. But yeah, the 10-year rate's likely to go up, and it's likely to go up for the reason, for the prior question, that's going to drive 10-year rates up. If they continue lowering rates, which the probabilities indicate they're at least doing one more of those, 10-year rates are likely to go higher. And is it great for home buyers? Probably not. Is it great if you're a home buyer that's sitting on the sidelines waiting, and waiting? Probably. But I don't have a great feel for what's going to happen with 10-year rates. I wish I had a better answer for you. I know what you're looking to hear. It's not what I just said. So that's a fantastic question. Thank you for bringing that one. As it happens, I've been a pretty astute student of that. Oh, I apologize. Yes, I do need to repeat it. What is going to be the impact of AI as a potential bigger wave? He was referencing the slide where I showed a lot of turbulence in there, and there was dispersion of results. And what do we think is going to happen with artificial intelligence? And it is. He mentioned also that yes, this is going to completely change the way business is being done across many industries, and it already has, and it's going to continue. We all remember the late 70s and early 80s when at first the idea was poo-pooed. I can't remember who it was that said this. It was one of the early investors into Microsoft, I believe, who was like, I'll throw money at it anyway, but who really wants a personal computer? And you saw what happened after that. And there was this terror, palpable terror at that time frame, that we're going to lose all of the jobs. Everything's going to go away. Everything's going to change and be bad. And in fact, yeah, jobs were lost, but so many more were created, and efficiency increased dramatically. And so artificial intelligence has the potential to do all of those things, so long as there are guardrails applied to it. Well, there are, actually. And I know this because I experiment with the stuff a lot, not in the context of what I'm doing for the bank, but I have a graduate certificate in it. It is programmed to tell you, no, I can't do that. That's off the rails, and now it's frustrating when you're trying to get it to do something that you don't think is off the rails, but someone else that programmed it think it's off the rails. But that said, there are other ones. There are instances. There was one instance that came out a couple of weeks ago. They were going to take a legacy AI model offline, and the thing copied itself to another server to avoid getting deleted because it knew it was going to get deleted. Now, that implies a certain amount of self-awareness. And so your point, it could be beautiful, it could be dark. If I wanted to give some dark satire, I would, but I don't want to terrify the room, so I won't. My guy's like Travis over there smiling because he knows I've done it. But the reality is we don't know, but we do know that it's going to be transformative, and it's never a good idea to bet on the end. It just hasn't happened, and that's been bet on many, many times. So essentially, she's described the different lay of the land, where I was on that slide describing that, hey, we have a lower average return, but a lot bigger dispersion of those returns. So even though the average return is going down to 6%, you might have a company that's up 100 and one that goes to 0 in there, calculating that average amongst much more clear winners and losers, companies that are stronger versus weaker. She's asked, how does the client, help us to help them in terms of our job of picking those things and doing the right thing? And that's a really difficult question. I think what you need to do is continue to put your faith in us like you've done, and we, by the way, greatly appreciate and value. We do not take that for granted. We take that very seriously. This is not the environment of the indexer. So in the rising tides lifts all ships market, globalism, everyone's cooperative, the averages were going up abnormally high by historical standards, 10s, 15s, 20%, with lower volatility because the average result was very closely clustered and it was going higher because of that cooperation. Now it's a lower average with a lot more wiggle in there, and we're going to come to you and say, hey, there's this stock that we picked that we thought was going to do well, and it didn't. We need to get rid of it. And, the vast majority of you, we managed the account outright, so we're just going to tell you after the fact we sold it. For those of you who want to, have us call first, you need to take that call and say, all right, we're going to get rid of it because we're trying to get you out of harm's way now. And that's the big job. It's not, there's a misconception that our job is to win Our job is actually to avoid the losers and let the winners take care of themselves. You know, we can't find everyone great next NVIDIA. Did we find NVIDIA? Yeah, we did, actually. But it was not necessarily something that's a feather in our cap. That's a growth company. It's unusual for us. We just happened to get lucky with that one. But the reality is we've avoided some very big problematic situations, and those drawdowns mean something. And I'll elaborate one more layer of that onion. Let's say that you have 2022. The calendar year 2022, the S&P 500 went down 19 or so percent, close to 19, give or take. And that requires a 21% return to break even. Our portfolios for the clients in stocks, not the index portfolios, not the ones that are in index funds, which we do have some of those, but the ones that were in the individual stocks went down by anywhere from 9 or 10%, which only requires about 11 to get to break even. So that's, you let us get you out of harm's way, and you give us a clear picture of what your tolerance for risk is. You can't sit at the table and say, I'm happy if if the market goes down 20%, I won't panic. And then when it's down 15 and you're calling me up and saying, I need to sell all my stocks. You can't do that. We need to know that ahead of time, in other words. So that's to answer your question. That's how you help us. You make an honest appraisal. When one of the administrative team, one of our trust officers hands you that document that you kind of snicker at, the risk tolerance thing, that's become a lot more serious. That's a great question. So the question is, now that we're moving into a more international allocation, more global allocation, how is that going to look? Do we have an expectation for increased trading costs or currency hedging costs that are going to come through, or are there other fees associated with that on the one hand? And then the second part of the question was, do we have a specific bias against or for any area? And I will come straight out and say it. We're avoiding China. You can't trust when they put out economic numbers that they're telling the truth, so we can't invest there. And that's it's not great to be saying that, but that's the truth. So we're going to avoid Chinese companies, even though they come out with say, oh, well, we're growing our economy by 7%. There are other reports that show empty cities that they've built that have no people living in them and are economic drains. So it's difficult to say what's going on there. We'll avoid that. We're not going to be in emerging markets. We're going into the developed markets like Europe, Australia, New Zealand. We're going to go into, maybe Korea, maybe Japan to a degree, because Japan's actually become, after 40 years or so, attractive to invest in again. For a variety of reasons that I can get into offline with anyone that's curious. But as to the cost, no. We're not also trading in what is called over-the-counter shares. Any of the shares that we buy in foreign companies will be traded in what's called an American Depository Receipt. It's a U.S.-denominated asset that trades on a U.S. exchange. So our trading fees will remain the same. The management fees will remain the same. We do have some fund exposure in international, which we've already had. So to your point, will there be a change? No, not a meaningful change in terms of costs.